$74.6 billion. That's how much the Federal Reserve injected into the banking system on December 31st, 2025, not through normal channels, not through scheduled operations, through an emergency facility that wasn't supposed to be used like this anymore. The largest single-day repo operation in American history, and it happened on the same day silver shattered $90 per ounce for the first time ever. The official explanation from the New York Fed was predictable. Year-end liquidity management, routine adjustments, temporary funding needs. Nothing to see here. Move along. But here's what they didn't mention in the press release. 9 days earlier, on December 22nd, the Fed had already started pumping billions into the system. 6.8 billion here, 34 billion there. By the time December 31st arrived, the cumulative injections had reached levels not seen since the darkest days of the pandemic. The standing repo facility, which had been largely dormant for years, suddenly became the most active tool in the Fed's arsenal. Connect these dots. On November 15th, the New York Fed quietly removed the $500 billion cap on its standing repo facility. The official language called it operational flexibility. The unofficial translation was clear to anyone paying attention. They were preparing for something big. They were expecting banks to need unlimited access to emergency cash. Then came the timing that no mainstream outlet bothered to investigate. On December 28th, a Sunday when banks are closed and markets are silent, the New York Fed infused $34 billion into one or more Wall Street institutions. The identity of those borrowers remains classified under Federal Reserve disclosure rule. We won't know who needed that emergency funding until 2028. But the real story wasn't just about the Fed's liquidity injections. It was about what was happening simultaneously in a market that most Americans never think about. The silver market was experiencing something unprecedented, and the collision of these two events reveals a pattern that changes everything we thought we knew about the stability of our financial system. The numbers tell a story that official narratives cannot hide. On December 29, 2025, silver touched $84 per ounce. That's not a type $84, the highest price in the history of the metal, higher than the Hunt brothers squeeze in 1980. Higher than anyone on Wall Street had predicted even 6 months earlier, and this wasn't a brief spike that reversed within hours. Silver had been climbing relentlessly throughout December, gaining 27% in a single month. The mainstream financial press attributed the move to speculation, to momentum traders, to irrational exuberance in the precious metals space. What they failed to report was the fundamental supply crisis that made this rally not just possible, but inevitable. Let's start with the COMEX, the primary exchange where silver futures are traded in the United States. In early January 2026, something extraordinary happened. In just 7 days, between early and mid-January, 33.45 million ounces of silver were physically withdrawn for delivery. That represented roughly 26% of COMEX's entire registered inventory disappearing in a single week. Think about that number for a moment. More than a quarter of the available silver that backs futures contracts on America's largest commodities exchange vanished in 7 trading days. Traders weren't rolling their contracts forward as they normally do. They weren't taking cash settlement. They were demanding physical net, and they wanted it immediately. The January 7th data from the CME tells an even more revealing story. Holders of 1,624 January 2026 silver contracts received delivery of 8.1 million ounces of silver. JP Morgan issued 99% of that total. The largest bullion bank in the world was on the other side of these deliveries, handing over physical metal to buyers who refused to accept anything else. But here's where the data gets truly alarming. Despite this massive delivery, the open interest for January actually increased by 1,431 contracts. More buyers were stepping in. February silver futures also increased by 1,564 contracts. The market was sending an unmistakable signal. Traders were using the COMEX not as a hedging market, which is its intended purpose, but as a physical delivery market. They wanted silver, real silver, and they wanted it now. This wasn't speculation. This was a structural change in how the market functioned. The reasons behind this shift became clear when you examine what happened on January 1st, 2026. China, the world's largest refiner of silver, implemented strict new export licensing requirements. This wasn't a complete ban, despite what some headlines suggested. It was something potentially more powerful, a chokehold on supply that Beijing could tighten or loosen at will. Under the new policy, only 44 companies received government approval to export silver over the 2020s. To qualify, firms needed to demonstrate proven export records from 2022 to 2024, possess annual production capacity exceeding 80 tons, and maintain a credit line of at least $30 million. Smaller players were effectively locked out of the export market entirely. The implications were immediate and severe. China accounts for approximately 15% of global silver production, but more critically, Chinese refineries process a massive portion of the world's silver ore into finished product. By controlling who can export and how much, Beijing effectively controls the flow of refined silver to Western markets. The state-run Securities Times cited an unnamed industry insider who explained that the new policy formally elevates silver from an ordinary commodity to a strategic material, placing its export controls on the same regulatory footing as rare. The same playbook China used to dominate critical minerals was now being applied to silver. Elon Musk responded on his social media platform with unusual bluntness. "This is not good," he wrote. "Silver is needed in many industrial processes." Coming from the CEO of Tesla, a company whose electric vehicles require significant amounts of silver, the concern was more than theoretical. The timing of China's move was not coincidental. Throughout 2025, Chinese exports of silver had actually increased dramatically. In October alone, China exported a record 660 tons of silver. Much of this metal flowed to warehouses in Western financial centers like London and New York. Analysts now believe this represented front-loading, Chinese exporters rushing to deliver goods before the new restrictions took effect. That supply line has now been cut. Western industries that relied on Chinese silver face a stark new reality: higher costs, supply uncertainty, and a market where physical metal commands premiums that would have seemed absurd just months ago. The divergence between paper and physical silver prices became the most visible symptom of the structural crisis. While COMEX futures quoted silver around $72 per ounce in early January, physical metal was changing hands at dramatically different prices depending on where you looked. In Tokyo, physical silver reached premiums as high as $130 per ounce. Dubai reported the lowest price for a 1-ounce silver coin at $99.93. Shanghai physical metal traded at premiums exceeding 12% above theoretical spot prices. The gap between what the paper market said silver was worth and what buyers actually paid for real metal had never been wider. This $60 per ounce gap between paper and physical prices represents something far more significant than market inefficiency. It signals a fundamental breakdown in the pricing mechanism that has governed the silver market for over 50 years. The era of paper price discovery may be coming to an end. The ratio of paper silver contracts to real physical ounces backing them had reached 356 to 1. For every single ounce of real silver, there were 356 ounces worth of paper promises trading in derivatives markets. When traders began demanding physical delivery instead of accepting cash settlement, the math simply didn't work. Now let's return to the Federal Reserve's December 31st intervention and examine why it occurred precisely when silver was breaking records. The COMEX had implemented multiple margin hikes throughout late December in response to silver's parabolic price movement. The CME Group raised margins on both gold and silver twice in a single week. The Shanghai Gold Exchange increased its silver margin requirement to 20%. These were emergency measures designed to cool speculation and reduce leverage in the system. But margin hikes create a different kind of problem. When exchanges raise margin requirements, traders must immediately deposit additional cash to maintain their positions. For institutions holding large short positions in silver, this meant finding billions of dollars in liquidity within hours. The alternative was forced liquidation at the worst possible prices. The David K. Johnston investigation, published on January 1st, on Sunday, December 28th, at 5 p.m., when banks are closed, the New York Fed infused one or more Wall Street banks with $34 billion of cash. Soon after, the Chicago Mercantile Exchange tightened requirements to speculate in silver and gold. The CME said this was routine. The evidence suggests otherwise. The cascading liquidity injections were indicative of investment banks being forced to meet increasing reserve minimums on silver futures. Banks holding short positions didn't want to close those positions at current price. They were betting that silver would eventually decline,
allowing them to minimize losses. But to maintain those positions, they needed cash, massive amounts of cash, and they needed it immediately. The Fed's standing repo facility provided that cash, $74.6 billion on December 31st alone, secured by $31.5 billion in Treasury bonds and $43.1 billion in mortgage-backed securities. The borrowers' identities remain confidential, but the circumstantial evidence points to institutions with significant exposure to precious metals, derivatives. The October 31st repo operation had already set records at $50.35 billion. That was month-end funding pressure, the Fed explained. But December 31st $74.6 billion dwarfed even that number, and it occurred as silver touched all-time highs, as margin requirements were being hiked, and as physical delivery demands were draining COMEX vault. The Wall Street analysis of the Fed's balance sheet revealed additional details the mainstream press ignored. The Fed also added $38 billion in short-term Treasury bills during December. $15 billion replaced mortgage-backed securities that left the balance sheet. $23 billion were reserve management purchases designed to increase bank reserves. The Fed maintained these weren't quantitative easing, but the liquidity injection was the largest since the Fed officially ended quantitative tightening on December 1st. The Federal Reserve ended quantitative tightening exactly 1 month before executing its largest emergency lending operations since the pandemic. The program that was supposed to shrink the Fed's balance sheet by $95 billion per month was terminated just as silver markets began their historic run. Meanwhile, the physical silver market continued to tighten. COMEX registered inventories had fallen 70% from their 2020 peak, dropping from 346 million ounces to approximately 82 million ounces. London Bullion Market Association vaults had lost around 40% of their holding. Shanghai inventories hit decade lows. At current consumption rates, some industrial regions had barely 30 to 45 days of accessible silver reserves. The structural deficit in the silver market was entering its 5th consecutive year. Throughout 2025, global silver demand reached an estimated 1.24 billion ounces, while total supply, including mine production and recycling, only amounted to about 1.01 billion ounces, a gap of 230 million ounces. 230 million ounces more demand than supply, and this deficit had been compounding for years, with total cumulative shortfalls exceeding 678 million ounces over 4 years. The supply side offered no easy solution. 75 to 80% of silver production comes as a byproduct from copper, zinc, and lead mining. Higher silver prices cannot stimulate production increases if base metal economics don't justify operation. Primary silver mines comprise only 25 to 28% of global output. There is no switch that can be flipped to produce more silver. The metal comes out of the ground at the pace geology and economics allow, not at the pace industrial demand required. And industrial demand was accelerating precisely when supply was constrained. The renewable energy sector, particularly photovoltaic manufacturing, consumed enormous quantities of silver paste for solar panel production. Electric vehicle manufacturing required significant silver content. AI hardware and semiconductor production added another layer of demand. These industries didn't reduce consumption. When prices rose, they couldn't. Silver's conductivity properties have no adequate substitute in high-efficiency applications. The major banks had noted their forecasts for 2026 told a story of capitulation to reality. Citigroup projected silver could reach $100 per ounce by March and $110 by the second half of 20.
Bank of America issued an alert with a $309 long-term target. JP Morgan and Goldman Sachs raised their gold forecasts to $5,000 per ounce by Q4 2026, with some analysts projecting $6,000 longer term. These weren't fringe predictions from precious metals enthusiasts. These were the same institutions that had dismissed silver as a speculative commodity for years.
Their models had changed because the data forced them to change. Central bank gold buying provided additional context for the precious metals shift. The World Gold Council reported that central banks purchased 220 tons in Q3 2025 alone, bringing year-to-date totals to 634 tons through the third quarter. JP Morgan projected around 755 tons of central bank purchases. This represented a structural change in how sovereign nations viewed reserve assets. The BRICS nations were leading this shift. China's People's Bank had extended its buying streak to 12 consecutive months, adding 25 tons. Since the end, gold now accounted for 8% of China's foreign exchange reserves, up from 5.5% a year earlier. Brazil's central bank re-entered the market after a 2-year pause, accumulating 31 tons over 2 months. These weren't tactical trades, these were strategic reallocations away from dollar-denominated assets. The U.S. government's response revealed how seriously Washington viewed the situation. In November, the Bureau of Industry and Security added silver to the nationally designated list of critical minerals, citing its use in electrical circuits, batteries, solar cells, and antibacterial medical instruments. A review scheduled for January-February 2026 would determine if silver posed a threat to national security. Think about that designation. The same metal that most Americans associate with jewelry and coins was now classified alongside rare earth elements as critical to national defense. The same metal that China had just restricted was suddenly a strategic priority for the United States. The convergence of these forces created what analysts described as the most severe supply crisis in modern silver market history. Prices weren't merely rising, they were repricing to reflect a fundamental reassessment of silver's role in the global economy. No longer just an industrial commodity or a monetary relic, silver had become a triple identity asset. Industrial, monetary, and strategic. Institutional investors and major banks were quietly realigning their strategies. Many were converting paper ETF holdings into allocated physical positions, securing delivery before liquidity disappeared. Others were building private inventory reserves, anticipating prolonged export restrictions and logistical bottlenecks.
Reports emerged of Chinese companies contacting Canadian silver producers, offering to buy physical metal at $8 to $10 above market price.
The February contract loomed as the next potential flashpoint. Open interest remained elevated. Traders who had taken delivery in January were likely to do so again, and COMEX vault levels continued to decline despite the margin hikes designed to reduce speculative pressure. The exchange faced an uncomfortable question: what happens when delivery demand exceeds available supply? The precedent from London suggested answers that exchange operators didn't want to discuss publicly.
Throughout 2025, the City of London's physical silver market, the world's largest, had experienced delivery dysfunction and even days of trading dysfunction. These episodes revealed that London held almost no physical silver relative to the billions of ounces theoretically represented by trading claims. The London problem, as some analysts called it, was spreading to New York. Cash settlement had always been the escape valve. When physical metal wasn't available, exchanges could settle contracts in dollars instead of silver, but forced cash settlement creates its own problems. It confirms that paper claims cannot be honored with real metal. It damages confidence in the exchange as a delivery mechanism, and it invites regulatory scrutiny that exchanges prefer to avoid. The first signs of this breaking point appeared in the premium spreads. When physical silver trades $60 above paper prices, the market is sending an unmistakable message. The paper price is not the real price. The digital number on a screen is no longer a reliable indicator of the cost to acquire the physical asset. Price and value have officially diverged. For 50 years, the global price of silver has been discovered in the futures markets of New York and London. That era may be ended. Shanghai was now setting physical prices that the West had to match or go without metal. The commodity de-dollarization that analysts had discussed as a theoretical possibility was becoming operational reality in the silver market. The Federal Reserve's $74.6 billion intervention on December 31st takes on new meaning. In this context, it wasn't just year-end liquidity management, it was emergency support for institutions caught on the wrong side of a market that was fundamentally repriced. The banks that had profited for decades by selling paper silver against limited physical reserves were facing margin calls they couldn't meet without central bank assistance. The removal of the $500 billion cap on the standing repo facility in November wasn't precaution, it was essential. Regulators do not remove limits on emergency funding unless they expect bigger and more frequent cash calls ahead. The opacity of the Fed's lending, with borrower identities classified for years, prevents markets and the public from assessing who is exposed and how concentrated the risk may be. The questions that remain unanswered are the ones that matter most. If the investment banks receiving emergency Fed funding cannot repay those loans,
What happens next?
If COMEX registered inventory continues to decline while delivery demands increase, how does the exchange maintain credibility? If China further restricts silver exports, how do Western manufacturers secure the metal they need for solar panels, electric vehicles, and semiconductors? The silver market of January 2026 stands at an inflection point. The old model, where paper derivatives set global prices while physical metal remained an afterthought, is failing in real time. The new model, where physical scarcity determines value and paper claims face skepticism, is emerging through crisis rather than design.
The Federal Reserve can inject liquidity, exchanges can raise margins, central banks can issue reassuring statements, but none of these actions can create silver that doesn't exist. None of them can force China to export metal it wants to. None of them can close a 230 million ounce annual supply deficit. The data points we've examined today are not predictions or speculation. They are reported facts from official sources. The Fed's $74.6 billion injection is documented in New York Fed operations data. The COMEX inventory decline is public information from CME Group. China's export restrictions are official policy from the Ministry of Commerce. The physical premiums are being reported by traders in Tokyo, Dubai, and Shanghai. What happens next depends on forces that no single institution controls. The silver market has entered territory where historical models provide limited guidance. The Hunt brothers squeeze of 1980 was ultimately broken by exchange rule changes and Federal Reserve policy, but the current situation involves structural supply deficits, industrial demand that cannot be reduced, and geopolitical fragmentation that limits traditional solutions. Watch the COMEX inventory reports in the coming weeks. Watch the February delivery notice. Watch the physical premium spreads between Shanghai and New York. Watch the Fed's repo facility usage. These data points will tell the next chapter of this story before any official announcement confirms it. The mainstream financial press will continue to frame this as market volatility to be managed. The data suggests something more fundamental, a repricing of silver as a strategic asset in a world where physical supply cannot meet physical demand, a repricing of confidence in paper markets that cannot honor their delivery obligations, a repricing of risk for institutions that built business models on assumptions that no longer hold. The $74.6 billion question isn't whether the Fed can provide more liquidity. The question is whether liquidity can solve a problem that is fundamentally about physical metal that doesn't exist in sufficient quantities. So far, the market's answer is becoming clearer by the day. This story is not over. The February contract expiration approach. China's export policy remains in flux. The Fed's balance sheet continues to expand, and silver's price discovery mechanism is migrating from paper markets in the West to physical markets in the East. The implications extend far beyond precious metals investors to anyone who cares about the stability of financial markets and the integrity of price discovery in critical commodities. The vault is draining, the questions are multiplying, and the official explanations are becoming harder to reconcile with the data. Follow the numbers, they don't lie.